When it comes to gold, I think the pullback will be maybe $200 or $300 at most, which is nothing. When you're talking about $5,200 gold, silver, you could be in for a rougher ride, but I think it'll be an even more prosperous ride. So, I don't think silver is going to go below 70. But that's still, you're talking the upper 80s now. But the thing is, the premiums are moving higher too. So even if silver were to dump, the premiums might not go down nearly as much. So I would just buy the physical. The better buy right now, I think, are the mining stocks. I think they're ridiculously cheap. Even though they've tripled, they're cheaper than they were before they tripled based on their earnings and the underlying value of their businesses and how much future earnings are likely to grow.
What if gold's breakout is not just about war headlines? What if something much bigger is unfolding quietly inside the derivatives market? Massive long-dated call options, unusual positioning, and a global financial system already under strain. This isn't just another rally. This could be the early signal of a structural shift. Over the weekend, gold priced in euros surged to a fresh all-time high. In dollar terms, it hesitated, but that divergence is tactical, not structural. When fear spikes, the dollar often gets a temporary bid. Capital runs toward what feels familiar, but beneath that surface reaction, inflation remains persistent. Debt continues expanding. Bond markets are under pressure, and gold responds to long-term monetary stress, not headlines. Conflict changes everything. It increases government spending, it expands fiscal deficits, it forces bond issuance higher, and it injects volatility into energy markets. Initially, higher interest rates may support the dollar, but over time, those same higher rates strain already stretched sovereign balance sheets. More debt, higher servicing costs, more currency dilution. And when confidence in fiat begins to erode, capital searches for permanence. Gold does not depend on policy credibility. It carries no counterparty risk. That's why it becomes attractive, not as speculation, but as preservation. Now, here's where things become more interesting. Unusually large volumes of long-dated gold call options have appeared targeting dramatically higher price levels into late 2026. A call option is a leveraged bet on higher prices, and these are not short-term trades. They suggest expectations of prolonged stress, extended instability, or systemic repricing. We've seen something similar before in silver. Heavy call accumulation occurred months before major expansions. Large players positioned early, quietly, before the narrative caught up. The question is simple. Are we witnessing that pattern again?
I think the momentum is to the upside. I mean, there's no momentum to the downside. Yes, we had about a week or so where prices really spiked up for gold and silver, more so for silver than gold, but gold got above 5,500 very quickly, and silver got above 120, and they both pulled back, but gold has found support around 5,000, which is still a pretty high number compared to where we were, not necessarily compared to where we're going. And silver really has a lot of strong support in the low 70s. But there's been a pickup in the volatility of silver, but the trend is clearly up, and we're trading at 87.5 right now. And more significantly for silver, we broke through that $50 double top that really overhung the market since 1980. And so I think the chart looks phenomenal for silver. I think silver is going to take out the high of 121. But in the meantime, I think the mining stocks are a good forward-looking indicator now.
In moments of fear, the dollar rises, but rising bond yields create pressure. Higher yields mean higher debt servicing costs. Higher debt servicing costs require more issuance. That cycle feeds itself. Short-term strength can mask long-term fragility, because when debt grows faster than productivity, confidence erodes. Gold doesn't require confidence in government balance sheets. It simply exists. And in periods of monetary stress, that simplicity becomes powerful. Another layer to this story lies within futures markets. There were allegations that recent trading halts were not technical glitches, but emergency interventions. When open interest stretches available registered inventory, pressure builds. If too many participants demand physical delivery at once, structural weaknesses are exposed. Temporary halts allow time for cash settlements, time for rollovers, time to ease pressure. But it raises a deeper question. Does paper pricing truly reflect physical reality, especially in silver, where inventories are tighter? If physical demand surges while paper supply expands, a repricing gap could eventually emerge. Energy markets are central to monetary power. Higher oil prices shift trade balances. They reshape alliances. They alter currency flows. If major economies increasingly trade outside the dollar system, demand for dollars gradually declines. At the same time, debt expands. Inflation persists. Confidence thins. Not overnight collapse, but gradual structural transition. And historically, precious metals perform during transitions. If inflation reaccelerates, bonds suffer. Rising yields push bond prices down. Purchasing power erodes. War becomes both distraction and accelerant. Prices spike blamed on conflict, then partially retreat. But the baseline never fully resets. The new normal sits higher, and over time, that compounds quietly. We are seeing technical breakouts, massive option positioning, fiscal expansion, geopolitical escalation. If physical demand intensifies while paper markets stretch inventory limits, could we witness a structural repricing between paper and physical metal? And if that happens, what does it mean for bond markets?
So are the mining stocks kind of the canary in the coal mine here? Are they the leading indicator for what's to come later on for the metals? Because
they haven't been for a while because they've kind of been wrong. The miners have been anticipating a big drop in precious metals prices for years. That hasn't really happened. But now I think that investors are starting to accept the fact that gold and silver aren't going to crash. And pretty soon they're going to accept the fact that they're going to keep going up. But just realizing that they're not going to crash is a big step because that's an acknowledgement of how cheap these mining stocks are. So money is flowing in there. But this is still early days in both central bank readopting gold in place of the dollar. That really started a couple of years ago where you really started to see a lot of central banks moving into gold. And I think the trend of retail investors and private institutions moving into gold just started probably this year. And that may be why you saw that initial spike earlier in the year. As we saw private investors for the first time in decades allocating something to the precious metals as opposed to allocating nothing. So I think we're still early in these trends. And so prices have a long way to rise.